Hello, everyone. Good afternoon. This is Dave Keller, the Chief Market Strategist here at StockCharts.com, coming at you live from our global headquarters in Redmond, Washington. Today, we're going to recap the action of the trading day, looking at stocks closing up 55 basis points. We're going to have our guest, Jesse Felder, talk about the fixed income markets, which should be really interesting given the dynamics of the day in the last couple weeks. We're going to highlight some of the stocks that are moving up and down. Ladies and gentlemen, this is the final bar. Everyone, welcome to the first edition of The Final Bar. This is our new closing bell show here on StockCharts TV. I want to thank you all so much for joining us today. Every weekday, 4 o'clock Eastern, we're going to break down the market movements from a technical perspective and then focus on the power of StockCharts.com to help illuminate market activity, help you make better decisions, help you understand market dynamics, and break apart the charts. The visualizations of the market that StockCharts.com gives us are the way that we're going to really make sense of things. So excited to go on this journey with you, and thanks again so much for being a part of it. I want to start with what's happening, just big picture. Obviously, pretty decent day for stocks, right? I mean, after last week, which we ended the week on kind of a down note, all of a sudden this week we're doing pretty well, kind of chipping away minute by minute, and looking at an intraday chart of the S&Ps the last couple days, last 3 days, 5-minute chart, and you can see we gapped up in the morning, had a nice run until lunch, then just sort of settled down. But overall, undeniably, we're at the highs of the last couple days, and it's held up pretty nicely. Here's a daily chart of the S&P 500, and just looking at the overall movement again, we're sort of in this overall range. It really hasn't gone anywhere in the last 2 months, and again, what the charts help show you is even with all the volatility, all the news headlines, all the noise, all the opportunities, stocks really haven't gone anywhere in 2 months, right? I mean, they've gone somewhere. They just directionally have not ended in a different place than where they started, and that's a theme that I think is frustrating. And I've always mentioned the most painful direction of the market is not up, it's not down, it's sideways. It's the lack of directional movement, because directional movement is what we tend to think of as giving us opportunities. But again, I think there are plenty of opportunities out there. It's always just a question of identifying them and figuring those things out. Looking again real quick at the market update, we're just going to break down what's happened leading into today, and then we'll get into some of the themes for the show here. Overall, the Nasdaq 100 really led the way up almost 1%, right? 88 basis points, which is pretty decent. Toward the bottom of the line, this is an area of concern that we'll talk about, right? The small caps, right? The juice, the stuff that you'd think would be leading in a good uptake or kind of lagging behind, right? So it was the largest names that were really driving, and really tech and healthcare were the story today, and that's what you can see down here in the sector breakdown, right? So technology up over 1%, healthcare right about there as well. Down at the bottom, we have financials, we have energy, and the movement in financials is a theme I know we've talked about and Tom and Aaron and others talked about on Market Watchers Live last week. Just this emergence of financials, if that's new leadership or not. And what when we look at the charts, what you'll find is on a day like today, with things moving up, it's not financials that are leading it. It's actually retailers. And talk about a group that's not been at the top of the list very often. This is pretty much it. So you have that, you have some computer sectors, and then semiconductors also up pretty strongly today. And again, that theme with semiconductors' relative performance, if something like semis can consistently be at the top of the list, overall, that's how bull markets tend to be made. But it has to happen consistently. It can't just happen one day and then that's it, right? So we'll have to keep watching that one. At the bottom of the list, and we're going to talk about this a little later in a segment called Shifting Stocks, we'll look at names that are sort of at the biggest moves in the scooter rankings, in the stock charts technical rankings. You'll see some of the gold names at the bottom, and you can see that gold obviously has taken a real breather after being a fantastic long-term emerging chart pattern, sort of slowing down a little bit. And the chart of the XAU not super encouraging. So we're now after the close here, and what you've seen on the chart of the XAU, we're actually broken down through previous support. So again, it's a little bit of a concern. It's, again, still short term, but that sort of pattern is really alternating from a period of accumulation to a period of distribution. I think that's one thing we have to pay attention to. I want to go real quickly through a couple other markets that I think are worth paying attention to here. A little later, and just to break down the show, we're going to have a mailbag section, and we've opened up an email, the final bar at StockCharts.com. I'll remind you of that a couple times during the course of the show. We had some people already sending some really good questions about stock charts, about the markets, just about specific securities, specific markets, and then just questions about how to think of them, how to look at them. And just as a quick preview, we're going to talk about a couple themes in that section today, specifically talking about small caps and talking about transports. And the chart of the small caps, I tell you what, it's one of those where, if you knew nothing else, if you did not look at a chart of the S&P 500 and just looked at this chart, how positive would you feel about the overall market environment? Here's today's action, sort of if you're a candlestick user, you'd call this a doji candle. That essentially just means the open and close are right about at the same levels. But we had this nice run up where small caps, this is the S&P 600 I'm looking at here, tested the highs from July and then just settled right back down. And at this point, I mean, look at the chart of the S&P directionally, we've gone nowhere for 2 months. This has gone nowhere for 6 months, right? So out of the big move, out of the lows at the end of December, we then sort of totally stabilized, and we're sort of in this sideways, frustrating sort of period. So again, knowing nothing else, just looking at a chart of the small caps, it's hard to be super encouraged by that. And the relative strength showing it really starting to roll over is not encouraging as well. Final thing I want to show you is just looking at one of my chart lists. This is the Mindful Investor chart list. And one of the things that we've looked at is market breadth. And what you can see here, this is the percent of S&P stocks above their 50-day moving average. Is what's happened on each one of these moves higher in the S&P 500. If you look down at the green line at the bottom, lower peaks, which tells you less and less stocks. Every time the market rallies, tries to get to new highs, less and less stocks actually participating in the form of going above their 50-day moving average. So overall, a bit of an area for concern, I would say. Last thing I want to show you, and then we're going to get to the mailbag. One of the themes that we'll look at here is now the relative performance in a little more clarity. So this is the ratio of the Russell 2000 to the S&P 500. So really the key small cap index versus large caps. And again, if you take a step back, know nothing else about the market overall, does this feel positive or negative? You'd have to say it feels more on the negative side, right? In general, over that longer period of time, if you have the smallest companies, the most speculative companies underperforming, that's not the time when you'd expect the market overall to be doing well. And until you see some sort of reverse higher, we really just haven't seen that momentum change. So overall, probably a check on the weaker side of the register. That's the market recap for today. We're going to switch gears now and go to the final bar mailbag. So I want to just read real quickly the question that we received. And thanks again, everyone that's sending questions so far to the final bar at StockCharts.com. That's the way that you can get your questions to us. And again, happy to address some of the things that you're looking at, questions on specific charts or just markets and how to think about them. One of the great questions, I'll just read a snippet. Some of you have been incredibly verbose, and that is totally fine because there's a lot of good themes we can unpack. But one of you in particular said, and I'll quote real quickly, small caps and transports that were lagging are going up. Please tell me why we're still in a bear market and what will indicate to you that we've entered a bull market. So what I just want to unpack just real quickly, those two different themes, and thanks again for the question there. How do we think about the movement in small caps and transportation stocks? So I'm going to go here to just a big picture breakdown. Here's a chart of the S&P 600. We go back. Let's start in particular looking at Dow theory, which is looking at transportation stocks. So the idea with Dow theory is from Charles Dow. This is 100 years ago plus. And he was the first to really come up with a lot of things that we think of as straightforward, obvious tools that you would use as a chart user. And one of them is just the idea of indexing stocks. So he had this idea of taking a group of stocks of 20 or 15, if I remember right, industrial names and then railroad stocks and looking at them together. And essentially, if the producers of goods, the industrials, were confirmed by the patterns of the transportation stocks, in this case, the form of the railroad. So it was the producers of goods and the distributors of goods. If those were moving together, then the market, the economy overall is in pretty good shape. If they're not confirming one another, that's where you have some concern. So let's look at specifically with Dow theory now. So it's very different because if you look at the members of the Dow, it's not sort of the big DuPont kind of industrials. It's a lot of things. It's banks, it's technology, it's consumer, because the economy looks obviously very different. But the pattern, the idea is still the same. This is sort of the broad, index in the form of the Dow Industrials, giving you the overall strength of that side of the economy. And then down here we have transports, which again, now we're including things like, FedEx or something, but also airlines. There's a lot of things that aren't actually distributing goods. But we still look at it as sort of two different parts of the economy, and do we see agreement? Now, what's happened now is if you look at the Dow, we've had a lower closing high, and that's what happened in the last couple of weeks, right? We corrected in August, we came back, and instead of eclipsing going to new highs like we did in July, we actually failed and did not confirm a new high there. But if you look at transports, they actually looked in a much better place. They actually appreciated much, much more. So the first 2 weeks in September actually rallied right up to the previous highs from July, but very notably never got above that. So when this happens, this popped up on my radar, sort of the red flag of, are we going to have some sort of Dow theory signal if we get one of these breaking out and the other did not? But in this case, actually, both of them failed. They did not make a new closing high. They both failed at that resistance level. So in answer to the question that you sent in, I would say, first off, what would be encouraging with transports? I would say something like transports breaks to a new closing high, and also that's confirmed by the industrials, right? And there are a lot of other ways to look at this, not just with transports, also things like the S&P and the NASDAQ. I've seen a lot of people do that. I call that the new Dow theory. There are a lot of ways you can look at different parts of the economy, but in this case in particular, you'd want to look at transports breaking to new closing highs. And instead of making a pattern of, equal lows, equal highs, you'd want that pattern to reverse. So right now, potentially we're making a new lower high, a new higher low, excuse me. We'll have to see if that actually plays out. At this point, it's not happening yet. So that's my response to one of those points on transportations. Let's pivot just a bit, and I want to talk about the idea of small caps, right? So there's a lot of different ways to break down small versus large, and all the different ways we could look at it. I want to bring up one chart in particular that's going to look at. Here we go. So this is looking at all the different pieces of the puzzle. So we have the S&P 500 in black. In red, we have the mid-cap index. In green, we have small caps. And then in blue at the bottom, we have micro caps. So if you look at what's happened, a couple things to orient yourself to this. You want to look at these peaks and valleys relative to the previous peaks and valleys. So the S&P did not make a new closing high. The mid-cap index did not make a new closing high. The small cap index actually was the only one of the four that did. It actually broke to a new closing high here. So if you just are looking at the closing values, small caps are actually the only one that suggested that we're in some sort of a continued uptrend instead of stalling at resistance. And here's micro caps here at the bottom that have been unable to eclipse it. But the question is really, is this sustainable, right? And what you've seen since then, if you just look at this far right portion of the chart, looking at the last couple weeks, we have the S&P pulling back a little bit, mid caps pulling back more, small caps pulling back more, micro caps pulling back the most. So that configuration where the most speculative, the highest beta, the juice is kind of coming down the most. That's what feels not so good. That's why a lot of the individual charts, if we look at a random small cap stock, it probably doesn't feel as good as it could have at another time. And the reason is essentially because of that issue, because of that movement, right? That stronger movement down of the smallest, most speculative companies versus some of the larger ones. So the question is, what would you look at for something like small cap? So for me, it always comes back to the broad index measures. So I'm looking at just the small cap index in particular. And again, I tend to go back and forth between the Russell 2000 and the S&P 600. And just real quickly, if you're not familiar with it, might be worth looking at it. The Russell 2000, obviously a lot more companies, 2000 versus 600, although the actual number varies, to be honest with you. But it's a much broader universe, and so it's going to have a little more focus on some of the smallest names in there. So a lot of times the charts will look almost identical, but not always. And especially if you use more of a mechanical system, something that's triggering when small caps are breaking out, you might want to be deliberate about which one of those you use and make sure you're familiar with what the signals have been historically, because a lot of times I've seen people get confused and then all of a sudden you're looking at the wrong thing. But here's a chart of the Russell 2000, and again, I would say to you, take a step back, ignore what you know about the markets. Overall, what does this tell you about the health of the markets? Are stocks going up, down, or sideways? And there is no way, looking at the last 6 months, that you can't answer sideways. And you can do that by the peaks. So you can see that the the Russell 2000 has failed at the 158 level numerous times, come right back down. And this month was no different. You can see the lows have been consistently around 144. It was a little higher back here, but the last couple of times it's pulled back there. But the moving averages really tell the story here. Look at the completely flat moving averages. There's no real directional movement. We're just mean reverting. We're trading around the central level of around 150. And that, for me, doesn't make me feel great about the direction in small caps. It tells me we're sort of sideways. So thanks again for your question on small caps and transports. Those are some of the ways that I would break that down. Again, if you've not done so already, if you have questions at any time, the final bar at StockCharts.com is the way to do it. Send me any questions you have about the markets, about with our guests coming on, and we're happy to include as many as we can on the show. We're going to take a quick break, and we'll be back with my guest, Jesse Felder. Thank you. Hey, everyone. Thanks again. Welcome back to the Final Bar. This is Dave Keller from StockCharts.com. I want to welcome on my guest today, Jesse Felder from the Felder Report. Jesse, welcome on. And listen, this is our first show in a new series, and thank you so much for agreeing to be my first guest. I really, really appreciate it.
Hey, I'm absolutely honored, and congrats on the new show. This should be fun.
Thank you. No, it's a lot of good stuff to do. And again, I've followed your work for a while. You've always been very generous on social media and with a lot of people sharing thoughts. So excited to hear what you have to say. You sent us a couple charts ahead of time. We're looking at a chart of the 10-year yield to start out with. What are you seeing overall?
Yeah, basically we've had this huge rally in bonds, this year, and it's driven by, falling interest rates. So this is a long-term chart of the 10-year yield. And you can see basically that indicator at the top is basically just the 12-month rate of change. We've seen the 10-year yield fall at about a 50%, or make about a 50% decline over the last 12 months. And that's really only happened two other times in the last 50 years. And there's been plenty of times when interest rates have dropped dramatically, but usually when you see rates drop this quickly over this period of time, they bounce back pretty quickly too. And we saw that in late 2008, we saw it in late 2011, early 2012. And so I think we're probably seeing a bottom in yields here too, just because the move has been so swift. But there's a couple other charts, that I sent too, just messages from the commodities markets that are also suggesting that we could see rates back up again. And they started to do earlier, kind of in the middle of this month. This is a chart that compares the 30-year Treasury yield to the oil price. And you can see usually these move in the same direction, that interest rates move up as oil prices move up and vice versa. In 2016, we saw yields plunge, to those lows that were just taken out, by the 30-year yield. And the oil price diverged pretty dramatically in that summer of 2016, kind of really suggesting that the move, that the drop in interest rates was probably overdone. We've seen that same kind of thing over this summer and into the fall, where we saw yields drop dramatically, but oil prices have still been kind of powering higher, at least sideways, if they haven't plunged. And so to me, that's one kind of red flag that commodity market is saying this drop in interest rates is probably overdone. But the final chart that I sent over shows the 10-year Treasury yield compared to the copper to gold ratio, and these are very highly correlated. And so, to take a look at what's going on in the copper and gold, I like to look at pretty regularly the futures positions in the futures markets. We saw last week gold hedgers, considered the smart money, commercials are essentially selling forward more gold than they ever have in history. So they have their largest net short position on in gold in history, while you have copper hedgers, almost the exact opposite situation. They're just off of their highest net long position in history. So to me, this tells me the smart money between, the copper and the gold hedgers are betting on this ratio moving significantly higher, at least copper prices being much stronger than gold prices going forward from here, which would be very supportive of higher interest rates. So all these things kind of together suggest to me that interest rates have hit an important low here and are due to rally.
These are just three fantastic charts, Jesse. Thanks so much, and thanks for talking through them. It strikes me as I'm looking at them how long-term they all are, and there's a lesson just on that. And I'm back on your first chart, looking at a monthly chart of the 10-year with the 12-month rate of change. And in my office, I used to have just a 10-year rate of change on the S&P 500, and I always said if I only had one chart in terms of like thinking of long-term secular cycles, like that's all you needed, because it just told you the overall trend. So this is such a great illustration of sort of the relative weakness of where we're at in yields relative to that historical trend. So my question to you, how do you compare this? How do you take this long-term monthly chart of the 10-year and then marry that with what you're seeing day to day? Because I think a lot of people obviously get really caught up in the short-term movements in bonds and stocks and others. How do you relate that to what you're seeing on the long-term chart? How do you balance those two?
Yeah, I mean, it's such a great question. I'm really glad you asked it, because whenever I find myself looking at daily charts too much, right? There's so much noise, and it's so hard to kind of come up with a view or an opinion on that time frame. So I always, whenever I'm kind of questioning, wait, what the heck is really going on here? I zoom out, and I think weekly charts are probably what I look at the most. But
right.
I think it's nice to look at the monthly charts, and I really like the feature that StockCharts has. It allows me to look at quarterly charts, because I think those can be valuable in their own right, and I haven't seen that on a lot of other platforms. So yeah, I really kind of like to take a long-term look, and I think it helps to understand the direction of the primary trend and kind of use that filter when you're looking at the short-term stuff. And so I guess what I'm talking about here is a longer-term potential trend shift, and so when I start looking at these longer-term dynamics, it really helps to inform that short-term view.
That's fantastic. Jesse Felder, thanks so much for coming on today. Ladies and gentlemen, I want to thank Jesse for joining us today. What a great lesson. And if you took nothing else away from his comments, although his take on bonds, on copper gold ratio, that's fantastic. I'd remind you the lesson of incorporating some of the longer term views into what you're doing. There's a lot to unpack there. Thanks again, Jesse.
Hey, thanks, David, and good luck with the new show.
Cheers. Thanks again, Jesse. Appreciate it. Going to rotate now, folks, to our next segment, Shifting Stocks. So one of the great capabilities on StockCharts.com that I found, I've been using the product for many years, and I'm excited to be here looking at it a lot more than I had been as before. And one of the things I discovered early on was scooter rankings, and it's essentially the StockCharts technical rating. It's a proprietary rating, although if you look on the website, we explain what the methodology is and everything. And it's just a way of quickly quantifying what's moving, right? And I think a lot of times the game for equity investors is knowing what's working and what's not. And all this does is it gives you a shorthand way of trying to do that. Just with the time we have this afternoon, I'm just going to take a couple examples. And here on my members dashboard, I essentially three things I look at every day. It's the top 10 stocks according to the scooter rankings. It's the most up on the day, and it's the most down on the day. And if you look at just those three things, you get a pretty good feel for what's been happening in terms of market movement. This is looking at the 10 stocks with the best rankings. This is in the large cap universe. So mid cap, small cap names aren't going to surface here. It's names you're probably going to know. And so just real quickly, thinking of what's shifting around, what's moving, the number one stock in terms of that rating, going from 1 down to whatever 1,000, is KLA Corp, right? And that's a semiconductor stock. So the fact that the number one stock according to the ranking is a semiconductor name probably tells you something about the, why you can be a little bit confident on the markets. And this is the relative performance of KLAC versus the S&P 500, holding up really, really nicely. I also want to point out, though, that a couple of these, if you notice for themes, are home builders, right? And the home builder index has actually been a really good mover. Something like Pulte Homes, new closing highs again today, up over 3650. And look at the relative performance of Pulte Homes. And if you look at other names, D.R. Horton, other names in that group, you're going to find a lot of relative strength lines moving up and to the right. So if you're not there, if you're not thinking of the home construction space, it might be a really good time to try to do that with how much a lot of those have done well. Here we're looking at the scooter rankings, the ones that have moved the most. And again, just to look at the quick chart, you click on Candle Glance, gives you this really good little visualization of it. And just looking through this list of what's interesting, a couple healthcare names that are on here, but also one I wanted to highlight was Advanced Auto Parts, AAP. So that the specialty sort of auto part retailers, auto parts stores have done really well. This is a group that had been fantastic and then on a relative basis really struggled so far this year. And so it's not really been the place to be. But look at how AAP has completely reversed. And I like that rotation from distribution to accumulation, now back above the 200-day, back to new closing highs, back above resistance. AAP is an interesting chart to watch. And then finally, I just want to finish off on the stocks making the biggest downward movements. You're going to see a lot of energy names, but I want to highlight NEM, Newmont Gold, and a lot of benchmarks is the only one you'll probably consider, but other gold stocks are sadly on this list. We saw how the HUI, the HUI index was down pretty good today. Newmont Mining down 1.25%, testing support around 37.50. So I don't think it's the end of the world just yet, but it's definitely a support level you want to pay attention to. So if you're not familiar with the scooter rankings and don't use them, this is a really good place on the dashboard to try to break them down a little bit, get a sense of what's moving and what's not. And those are a couple stocks that jumped out at me today. I'm going to rotate now to the 3 and 3. All right, so the 3 and 3, as we were talking about this show, we came up with the idea of every show, every weekday, let's come up with the 3 charts. So I love to ask guests, and I didn't have time with Jesse, unfortunately. I love to ask my guests, what's your one chart? If you only had one chart to show, what would it be? And I always get some really good ideas. And what we thought about this one was, let's do 3 charts in 3 minutes. And for time, we're probably going to cut that down just a skosh, but I'll try to get through these 3 pretty well. And so the idea is every day I'm going to give you 3 charts that I think if you're not watching, you should. The first one is looking at the relative performance of consumer discretionary versus consumer staples. Now, if you've heard me on StockCharts TV before, if you follow me on social media, I'm at Keller CMT on Twitter. Also at Final Bar SCTV will be our Twitter handle for this show. You'll see this chart surface up pretty regularly because it's one of my favorite ways of looking at offense versus defense in the consumer space. So if this line is going up, it's institutions making bets more on the offensive side. If it's going down, we're betting it more on the downside. This is undeniably in a downtrend according to my take on it. So you have lower lows, and most recently we've had a lower high. As that pattern continues, that tells you that institutions are getting or remaining more defensive than offensive. So that's not the way that extended bull moves are made, in my opinion. The second one I want to show you is the U.S. versus everything else. And this is actually the S&P 500, the U.S. benchmark versus ACWI, the All-Country World Index, which actually does include the U.S. So if you're not familiar, it's about 50% U.S. and 50% everything else, global markets, developed, emerging altogether. So it's essentially the U.S. versus the entire world. And as this line is going up, that is telling you that the U.S. is outperforming. If it's going down, it's underperforming. If I knew nothing about the world and just saw this as a stock chart, I would probably think of this on the long side, right? It's a long-term uptrend, which we like. It's a short-term pullback right to the 50-day moving average. Almost appears buyable if this is a chart of a stock. Now, it's not. It's showing you the U.S. versus the rest of the world. But I think it's noteworthy that that's the kind of thing you want to pay attention to. And the third one for the 3 and 3 is the S&P versus the TLT, stocks versus bonds. Thanks again to Jesse for sharing his charts on what we're going on. I want to show you that this ratio is going lower, which tells you that overall we're favoring bonds over stocks, at least in the short term. Boy, 30 minutes goes by in a tear when you're hosting the show, ladies and gentlemen. I promise I'm going to get better at getting through some content and focusing on the messages that I want to share with you. I want to thank everyone for joining me on the Final Bar today. Again, this is every weekday, 4 p.m. Eastern, 1 p.m. Pacific. I hope you'll continue to join me. If you didn't catch it earlier, we're going to do a mailbag section pretty regularly, and our email is thefinalbar@stockcharts.com. You can also get to us on Twitter at FinalBarSCTV. Hit us either way with any questions you'd want us to review, and we'll do it. Thank you all so much. Have a great night. We'll see you tomorrow on the Final Bar.